So you probably are familiar with with Zoom, but I just put this on here just to kind of highlight the features down here at the bottom. So of course, if you wanted to be on video, you could click on the video button and put yourself on camera. Chat is probably the biggest one. If you have a question, since there's not that many of us, you can always just use the raise hand feature, and then I'll just answer your question, or you can pop it in chat. Either way.
Sounds good.
All right, perfect. Let's see here. All right. So my name is Tiffany Kling. I am one of the mortgage loan officers here at Chartway Credit Union, and I've been with Chartway for about it'll be 19 years actually next month, which is hard to believe. But I've been doing mortgages for it's been roughly 6 years now, so I've really enjoyed that. Worn a few hats here at Chartway, but definitely mortgage has been one of my favorite departments for sure. And then Christine, once she can hop on, she can introduce herself, but she owns Cahoon Real Estate. So she's the CEO and founder of that realty company and has a team of realtors that she works with. And we've been working together for a couple, I would say 3 to 4 years now, and we do a lot of these types of workshops together. So she's great to work with. Um, so these are the items that we were going to be talking about today. Just kind of briefly go over the differences between a primary residence and a second home. Some of the requirements that like Fannie Mae and Freddie Mac have when it comes to second home loans. And then just a few tips to help boost your credit if that's needed. And then I was going to go over the types of loan programs that Chartway has to offer and some down payment sources that you can come up with. And then lastly, of course, since we are a credit union, if you're not already a member, you would just have to become a member prior to opening up a mortgage loan. And then, like I said, if you have a question, you could either just raise your hand or pop it in chat and we'll get to it as soon as possible. So the first thing, as far as what exactly is a second home, so the difference between primary and second. So primary is going to be, of course, where you live at. Majority of the year, it's typically closest to your place of work or where you go to school. It's also usually the address that's listed on your driver's license, tax documents, pay stubs, things like that. Whereas a second home is, used for vacation or a seasonal getaway. Not always, but it's typically at least 50 miles from your primary residence. So if you're trying to purchase a home that's closer than that, unless there's a circumstance that, would exclude that, then typically if it's like say in the same subdivision as the one that you live in, that would be more considered an investment property and not a second home. And then typically you only occupy the property just a portion of the year rather than all year round. And then not always, but a lot of times it is smaller in size than what your primary residence would be. And then these are the requirements. This is straight from the Fannie Mae selling guide. So it must be occupied by the borrower for some portion of the year. It is restricted to one unit dwellings, so that can be a single family home, townhome, or condo. It just can't be multiple units because then it would be considered more of an investment property. Um, and then it must be suitable for year-round occupancy, which, basically means it has to be livable. So it has to have, running water, electricity, that sort of thing. And then this is a big one. The borrower must have exclusive control over the property. So it can't be a situation where you have, like, say, a property management company that has full control over, who stays in the property or who rents out the property. You definitely, as the borrower and owner, have to have control over that property. Um, And then it must not be a rental property or timeshare arrangement. So you can receive rental income from a second home, but it just can't be rented all year round. And we can't use the rental income that you receive for qualifying purposes to purchase the second home. And then, of course, like I said, it can't be rented year round, so just a portion of the year. And then the last one, it can't be subject to any agreements that give, a management firm control over the occupancy of the property, which kind of goes back to the fourth bullet there, just meaning that you kind of have to control that property and who's staying in the property throughout the year. And then for as far as getting prepared to purchase a second home, these are kind of the top three items that I think are the most important as far as preparation. So the first one being reserves. Typically for second homes, there is a minimum reserve requirement of at least 2 months. It can be more depending on the criteria of the loan, such as credit and things like that, but that's usually the minimum amount required. And then, of course, with second homes, there is going to be a little bit more upfront costs that you would incur, a little bit higher than when you're purchasing a primary residence. So, like the first one listed, the larger down payment required. Typically, second homes require at least 10% down, which I'll go over in more detail when we get to the actual loan programs. And then the second one, EMD, stands for earnest money deposit. Again, depending on I would say the purchase price of the home, that can kind of determine how large that EMD is. But it may, especially being a vacation home, it may be a little bit higher in purchase price. So you may end up having a little bit higher EMD on those. And then the next one's a big one, the due diligence fee. You probably won't come across this in the state of Virginia, but in North Carolina, especially, and South Carolina, which is where a lot of people purchase vacation homes in this area anyway. The due diligence fee is required, and that's something that usually has a time limit to it. So you might be given, say, 2 weeks to, get the loan, get approved for the loan. If things were to go south after that, it's a good possibility that you would lose that due diligence fee. So that is something that's in addition to the EMD. And then home inspection, typically the home inspections are done kind of within that first week after you go under contract. And those can be, I would say, probably on average, like between, I would say 500 to 600 these days, as far as the average fee for those. And then appraisal is going to be about the same cost, kind of between that $500 to $600 amount. If the property being a second home is like on the water or something like that, it is typically a little bit higher fee for those when it comes to appraisal. And typically the home inspection is done first, and then the appraisal fee would be paid after that. So typically around, I would say, 1 to 2 weeks into the process is when we do the appraisal. And the appraisal fee is the one and only fee, lender fees anyway, that you do have to pay up front, even though it is part of your closing cost. And then, of course, the next one being closing cost. I would say typically the total closing costs for a loan are around like 3% of the loan amount if I had to give an average amount. But of course, that's an additional cost that you would have to pay on the day of closing. And then the last one I just put on there is furniture. I wouldn't recommend buying furniture before your loan closes, but that is something that, an expense that you may have, close to when you close on the home. And then the last one being ongoing expenses. A lot of, vacation homes have HOA fees or community fees, condo fees. So that's an added expense monthly, typically. And then, of course, maintenance and repairs. You're going to have, maintenance that's in addition to your primary residence that you own. And then you would be responsible, of course, for the any repairs needed to the home as well, especially if you do plan to rent it out a portion of the year. And then travel cost, of course, depending on how far the second home is from your primary residence. You would need to take that into consideration as well as an added expense, as well as taxes and insurance, because you're going to be, responsible for paying the taxes and insurance on the second home, in addition to your primary. And then the last one being utilities as well. So those are all kind of additional expenses that you would incur, when purchasing a second home. And then the second one being employment. So typically we do request 2 years of employment history from you when you apply for the loan. It's not to say that you have to be in the same employer for the full 2 years. We just collect that history. And there is typically a little bit lower debt to income ratio for the second home. So it is, a little bit tighter as far as qualifying for the loan than it would be for a primary residence. And you want to avoid changes such as going from a salary position to something like a mortgage loan officer. You don't want to become a mortgage loan officer and then try to get a mortgage because that could be problematic since most, loan officers have commission pay in addition sometimes to a base pay as well. And then part-time employment, I would say typically we want to see at least a year of part-time employment, preferably 2 years, but definitely at least a year is needed or we can't use the income at all. So just keep that in mind if you do happen to have a part-time job. And then the last one being credit. You certainly don't have to have perfect credit to get a mortgage loan, but you do want to generally, review your scores from time to time when possible, because that directly affects your, interest rate and payment, of course. You can go on to annualcreditreport.com and get one free credit report per year. I believe you have to pay for the scores themselves, but you could at least get the report and see if there's anything like fraudulent on there. And speaking of credit, here's a few things that I would say that, I mean, it's not a one size fits all for everybody as far as credit goes, but these are just a few things to keep in mind to keep your score, as high as possible. So the first being pay down revolving credit card debt to below 30% of whatever your balance is. If it's over 30%, it can typically start to negatively affect your credit score. And then, of course, review all accounts for accuracy. You want to make sure that somebody didn't open something in your name that you're not aware of. Um, and then always make your payments on time. That one seems seems simple, but payments do make up 35% of your credit score. So this is a very high impact if you do happen to have, at least a 30-day late that would be reported on the credit report. And typically, if you have a late payment, if it's within the most recent 6 months, that's when it has the most impact or most negative impact on the score. And you want to limit the amount of revolving debt that you have. So it's good to have a good mix of credit, a mortgage loan, credit cards, an installment loan, such as an auto loan. If you have a lot of different types of credit, that, gives you a better credit picture and it looks better to lenders as well. And then the last one is big to avoid creditor initiated inquiries. So when we pull your credit initially, when we do the application, it may be a little while before you actually go under contract, and then your loan goes to an underwriter for review. And once that happens, they can go back and see everything that's hit your credit from the time you applied all the way to closing. So you want to, avoid going out and buying new furniture for your second home or vacation home, in the midst of trying to do the loan application and the loan itself. Um, and then a couple don'ts. Try not to close accounts unless when we pull credit, sometimes it says that you have too much revolving debt. So in that case, maybe you would want to close some credit cards. But I would say in general, it's best not to close accounts because that can negatively affect your score. So I usually recommend keeping just at least a small balance on you, at least especially like credit cards, so that the creditor does not, close those out for inactivity. And then the second one, do not consolidate debt into one or two cards and close the rest. A lot of people do that just because it's easier to get, debt paid off. But if you have, like, say, five credit cards, and one of them is maxed out, but the other four have no balance, that actually is worse on your credit score than if you just had all five of them with a balance below 30%. Um, and then the very last one, with student loans, try not to let them default, because if you default, at least on a federal student loan, then it gets reported to a certain report that we pull, and that could be problematic as far as you getting qualified for a mortgage loan. And then the next one, so these are a few different types of loan programs that Chartway has to offer when it comes specifically to second homes. So the first one is a conventional loan. We have, several different terms available, anywhere from 10 to 30 years listed on there. Like I said earlier, the minimum down payment requirement for those loans is going to be 10%. For a second home. And then the minimum credit score required would be a 620. I would say in order to get probably a better interest rate, to try to have the minimum credit score be at least a 680 or higher, that would just be better as far as qualifying for the loan, since it is a second home. And then the second one on there, the adjustable rate mortgage, or ARMs as we call them, those the minimum credit score for those is a little bit higher. It's a 680. And again, it requires a 10% down payment. These types of loans do have a much lower interest rate option. If you compared like an adjustable rate mortgage to a conventional loan for a second home, sometimes it can be as much as, a full percent or even more than that, lower if you do an ARM loan versus a conventional. So the ARMs in particular that we have are, really great products for second homes specifically. And we do have four different options available, anywhere from a 10-1 down to a 5-1. And what that means is that it's a 30-year mortgage loan, but for example, the 10-1, the interest rate is only fixed for the first 10 years. And then after that, starting in year 11, the interest rate can adjust once a year. So that's what the one means. And then the 5-5, it would be fixed for the first 5 years and then adjust once and then be fixed for the next 5 years. And it would just keep going like that for the remainder of the loan. And with the ARM loans, you can refinance at any point, so you don't have to wait the full 5 years or 7 years or 10 years. You can refinance into a fixed rate if rates happen to go down. And then speaking of refinancing, I did put on here as well, for a rate and term refinance, we can go as high as 95% on the loan to value percentage. And then if you are trying to get cash out, as far as a refinance on a second home, we can go as high as 80% of the value on those. And then here's a few down payment sources that you can think of. So, of course, the kind of the more obvious one is checking or savings. If you have funds, of course, in an account, such as a checking or savings account, you can certainly pull from that. We're getting ready to come up on tax time, so tax refund is definitely a great time to save up for down payment, as well as bonuses if you are fortunate enough to get those either quarterly or annually. Um, and then gifted funds, you can also get gifted funds from a family member, or even there's actually a long list of of people that they consider eligible family members. Um, so this can be some of the more interesting ones. It can be a domestic partner, a fiance, a future in-law. It can also be a godparent, a former relative. So there's a lot of different folks who can qualify as eligible family members and that can give you gifted funds. And sorry you have to hop off, Kelly. But we will be recording the rest of the session, so I can certainly send you that link. So I hope you have a great night. Um, and then let's see. So another option for down payment sources is a 401k. So you can either withdraw the funds or you can also take out a loan from a 401k or a similar type of account. Typically with the 401ks, if you do the loan option, we don't count that against your debt to income ratio. So that's nice if you're purchasing a home. And then the next one, gift of equity, is unique. So those same folks that can gift you the gift funds, they can also gift you equity in the home. So say you're purchasing a second home that's 400,000 and maybe they're going to sell it to you for 300,000. That means you've got $100,000 of equity there. And they can gift that to you to pay for that 10% down payment, the closing costs. So it really helps out if you happen to have a family member or an eligible family member that can, sell you a second home. Um, and then seller concessions is another great way to get funds for closing costs. So it depends on how much you're putting down on the property. If you're putting down like 10%, then they could only give you up to 3% of the purchase price in seller concessions. If you're putting anywhere from 10 to 25% down, it increases a little bit to 6% that they can give you. And then if you're putting at least 25% down, they can give you up to 9% of the purchase price. And in case you were purchasing an investment property, in that case, a seller can only give you 2% of the purchase price. And then lender credits is another option as far as getting some help with, costs for the loan, down payment, and closing cost. So most people with just the way rates have been, they don't really want to increase the rate, but you do have the option with the interest rate where you can increase it a little bit and get what we call lender credits, or it's basically just money that we credit you towards, your closing costs to help you out with that cost to you. And then the next one, the home equity loan or line of credit. We do offer the option to do a simultaneous equity loan when you purchase a first mortgage. So say, for example, you're purchasing a second home, you've got the 10% down to um, put down on the loan. And then you need an additional 10%, or you would like to have an additional 10% down so that you can avoid any sort of mortgage insurance on the loan. So you can do a 10% down payment of your of your own funds, and then you can also do a 10% equity loan at the same time to make your total down payment 20%, and then therefore you avoid any mortgage insurance on the loan. And then the last one being a cash out refinance on your primary residence. So that is an option when you're purchasing a second home. So if you happen to have a primary residence that has a lot of equity, or maybe it's completely paid off, you can actually take out a first mortgage, but it would be considered a cash out refi and get funds in order to put that towards your down payment on the second home. So that is an option when you already own a home. All right. And then I included a copy of the Homebuyer Roadmap. So these these are the steps kind of from pre-approval all the way to closing when you're purchasing any home, whether it's a primary or second home. I just kind of put this visual guide up here just to kind of um, remind you of all the steps of the process. It is good to try to get pre-approved before you reach out to a realtor just so that they know how much that you are qualified for. And then, of course, you would shop for a home that you're interested in, make an offer. That's when, once you're under contract, as I mentioned earlier, you would do the home inspection and appraisal. You would also, of course, reach out to an insurance company to get homeowners insurance. The loan along the way is going to go to an underwriter to be underwritten and reviewed. And then once all of the conditions are in, then you get what's called clear to close, which is what we all want when we're doing the loan itself. Because once you've gotten to that point, you're pretty much towards the end, and you would do a final walkthrough with your realtor. And then, of course, that takes you to the day of closing and the day that you move in. So that's, like I said, just kind of a visual roadmap. If you join one of our first-time homebuyer sessions, we do go into a lot more detail of each of these steps, but I just wanted to put it on there as a reminder for anybody who's purchasing a second home. And then the last thing we have is our Chartway membership. So as I mentioned earlier, since we are a credit union, you do have to become a member prior to getting a loan with Chartway. So some ways that you can qualify include if you have an immediate family member that is already a member, that can be your way to qualify for membership. Um, you can also qualify by where you're located, your employer. And then another way to qualify is if you don't qualify by any of those other options, is to donate $10 to our Chartway Promise Foundation. This is our charitable arm, and the foundation raises funds for medically fragile children and their families to be able to grant wishes for them, such as like a trip to Disney World. So it's a near and dear charitable arm to us, and it's been around for a long time. So if that is your choice and you wanted, even if you want to donate, even if you do qualify by one of the other options, that's always a great choice. And it goes to a good organization. And that is all I have for today. So I did put my contact information up here. So again, my name is Tiffany Kling. I'm one of the mortgage loan officers here at Chartway. This is my cell phone number and my email where I can be reached. I do have 5 branches in the local area. So I've listed those on there as well. I'm not obviously at each branch every single day, but I do float around a few days a week to the various branches. So I appreciate all of your time today, and if there's any questions, we will take those at this time. And just so that you know, we do have additional workshops, both virtually and in person. So if you are interested in joining any of those, you can go on to the chartway.com website and then go to Why Chartway, select community, and then choose events, and you can register for any of those. So thank you again for joining the workshop, and that is all we have for you today.